Your brain is sabotaging your financial success every single day, and you don't even realize it. The reason you're not wealthy has nothing to do with how smart you are, how hard you work, or even how much you earn. It has everything to do with psychological biases and mental errors that are hardwired into your brain. It's causing you to make terrible money decisions over and over again. In the next 15 minutes, I'm going to expose the 7 most destructive psychological biases that are costing you thousands or even millions of dollars. More importantly, I'm going to show you exactly how to overcome each one so you can finally make rational financial decisions instead of emotional ones. Bias number 7 is the one that keeps most people poor their entire lives and almost nobody talks about it. So stick around, because understanding your own psychology is the key to unlocking wealth. Let's dive into how your brain is working against you. This knowledge will transform your relationship with money forever. Welcome back to the channel where we explore the real reasons people struggle with money and how to fix them. If you're new here, I focus on the psychological and behavioral aspects of personal finance because that's where most people fail. You can know all the right strategies, but if your psychology is broken, you'll sabotage yourself every time. Now, the field of behavioral finance and money psychology has exploded in recent years with groundbreaking research showing that humans are incredibly irrational with money. We make predictable, systematic errors that destroy wealth. But the good news is, once you understand these biases, you can create systems to overcome them. If this video helps you see your own blind spots, smash that like button and subscribe, because I dive deep into money psychology every week. Drop a comment telling me which bias you think affects you most. Alright, let's start with the first psychological trap that's destroying your financial decisions. The first psychological bias sabotaging your wealth is present bias, also called temporal discounting. And this is the tendency to prioritize immediate pleasure over future benefits. Your brain is wired to value rewards right now much more highly than rewards in the future, even if the future rewards are objectively much larger. This is why you buy things you don't need with money you don't have, eat dessert instead of losing weight later, and watch Netflix instead of working on your side business. Your brain gives you a massive dopamine hit for immediate gratification and basically nothing for delayed gratification. Even though delayed gratification is what builds wealth, here's how this plays out with money. You get your paycheck and your brain says spend it now on things that feel good immediately, like new clothes, eating out, buying gadgets, and entertainment. The idea of investing that money for retirement 30 years from now provides zero emotional satisfaction today, so you don't do it. You see something you want, and your brain says buy it now. Get that dopamine hit immediately. The rational part of your brain that says wait, you'll regret this tomorrow, gets drowned out by the emotional part screaming, I want it now. Studies have shown this with the famous marshmallow test, where kids who can delay gratification and wait for 2 marshmallows instead of eating one immediately end up more successful in life. But most adults can't even pass the marshmallow test with their own money. Here's a specific example. You have $1,000 and present bias makes you think I could buy a new TV right now and enjoy it today, versus investing it and having $2,600 in 10 years seems boring and far away. So you buy the TV, get 2 weeks of enjoyment, and then forget about it. But if you had invested that $1,000 in 10 years, you'd have $2,600. In 20 years, $6,700. In 30 years, $17,400. Meaning your present bias cost you $17,400 in future wealth for 2 weeks of TV enjoyment. This plays out thousands of times throughout your life with every spending decision. Here's how to overcome present bias. First, make future you more real and vivid by looking at age progression photos of yourself, writing letters to your future self, and creating a vision board of your retirement or financial freedom. The more real future you feels, the more your brain will care about future rewards. Second, automate good financial behaviors so present bias can't interfere by setting up automatic investments that happen on payday before you can spend the money. You can't give in to present bias if the money is gone before you see it. Third, use commitment devices that lock you into good decisions like putting money in retirement, accounts with early withdrawal penalties, or giving a friend $500 and telling them to only give it back if you stick to your budget for 3 months. Fourth, practice delayed gratification deliberately by waiting 24 hours. You want to buy something, or waiting 20 minutes when you want to eat junk food. Build your delayed gratification muscle like training at a gym, because the more you practice, the stronger it gets. Fifth, Reframe decisions in terms of opportunity cost by not thinking about the TV as costing $1,000, but thinking about it as costing $17,400 in future wealth, as that reframing helps you see the true cost and resist present bias. The second psychological bias destroying your wealth is loss aversion, which is the tendency to feel the pain of losses about twice as intensely as the pleasure of equivalent gains. Losing $100 feels roughly twice as bad as gaining $100 feels good. And this asymmetry causes terrible financial decisions. It makes you afraid to invest because you might lose money, even though the long-term odds are overwhelmingly in your favor. It makes you hold on to losing investments too long, hoping to break even instead of cutting losses. It makes you avoid necessary financial risks that could dramatically improve your life. Loss aversion keeps you paralyzed and poor. Here's how this manifests in real financial behavior. You have $10,000 sitting in a savings account earning basically nothing because you're afraid of losing it in the stock market. Rationally, you know that over 20 to 30 years, the stock market has always gone up and returned an average of 10% annually. But loss aversion makes you focus on the possibility of losing money in a crash, even though that loss would be temporary and insignificant compared to the long-term gains. So you keep your money in savings earning 0.5%, while inflation at 3% erodes your purchasing power, and losing money guaranteed through inflation. But that loss feels less painful than the potential loss from investing, which is irrational. But your brain doesn't care about rationality. Another example is holding losing stocks. You bought a stock at $100 per share, and now it's at $70. And you should rationally evaluate whether this stock is still a good investment going forward. But loss aversion makes you think I can't sell now because I'll lock in the loss. I'll just hold until it gets back to $100. This is called the sunk cost fallacy combined with loss aversion, where you're letting past losses dictate future decisions instead of making optimal forward-looking choices. Meanwhile, the stock might drop to $40 and you've lost even more. Or it might take 10 years to recover to $100 while better investments are making money. Loss aversion keeps you stuck in bad positions. Here's how to overcome loss aversion. First, reframe losses as learning experiences and necessary parts of the wealth-building process. Because every successful investor has losses and they're inevitable. What matters is having more wins than losses over time, so accept losses as tuition paid for financial education. Second, focus on probability and expected value, not emotional reactions to potential losses. If an investment has a 70% chance of gaining 15% and a 30% chance of losing 5%, the expected value is positive. You should take that bet repeatedly without letting the fear of the 30% scenario paralyze you. Third, use dollar cost averaging to reduce the emotional impact of market volatility by investing the same amount every month regardless of whether markets are up or down. This removes the fear of investing at the wrong time and smooths out your emotions. Fourth, set rules and systems that override your emotions by deciding in advance, I will invest X amount every month no matter what the market does, and I will sell any stock that drops 20% from my purchase price to limit losses. Having predetermined rules means you're not making emotional decisions in the moment when loss aversion is screaming at you. Fifth, remember that not investing is also a loss, just a less visible one. Money in savings losing to inflation is a guaranteed loss. Not taking career risks to earn more is an opportunity loss. So reframe inaction as a choice that also has costs, and suddenly taking action doesn't feel as scary. The third destructive bias is anchoring, where your brain latches onto the first piece of information you see and uses it as a reference point for all future decisions, even if that initial information is arbitrary or wrong. This causes you to make terrible financial choices because you're anchored to irrelevant numbers. Retailers exploit this constantly by showing you a jacket with a $300 price tag crossed out, on sale for $120. Your brain anchors to $300 and thinks, wow, $120 is a great deal. I'm saving $180, but the jacket was never worth $300. It was always worth $120 or less. The $300 anchor tricked you into thinking you're getting value when you're just paying retail price. This happens with salaries too, where your first salary becomes your anchor and affects every future negotiation. If your first job paid $45,000, you might feel great about a second job offering $55,000. Even though the market rate is $65,000, you're anchored to $45,000. So, $55,000 feels like a big win when you're actually leaving money on the table. Or you bought a stock at $100 and now it's at $70. So your brain is anchored to $100 and you refuse to sell, even though $70 might still be overvalued. You're waiting for it to get back to your anchor point, which is completely arbitrary and irrelevant to whether it's a good investment now. Real estate is another area where anchoring destroys wealth. You buy a house for $300,000, and 5 years later the market crashes, and similar houses are selling for $250,000. A buyer offers you $260,000, but your brain, anchored to $300,000, thinks no way, that's too low. The house is worth $300,000, so you refuse to sell even though $260,000 is actually above market value. You wait years for the market to recover to your anchor point while missing opportunities to sell and invest that money elsewhere. Anchoring keeps you trapped in bad decisions because you're using irrelevant reference points. Here's how to overcome anchoring. First, actively ignore the first number you see and do independent research to find the true value. If a product is on sale from $200 to $80, research what similar products actually sell for. Because if it's normally $85, the sale is meaningless. Second, in negotiations, try to set the first anchor yourself, instead of letting the other party anchor you low. If you're negotiating salary, research market rates thoroughly and throw out your number first, anchoring them high. Third, regularly reset your anchors by looking at current data and current reality, because what you paid for something in the past is irrelevant. What matters is what it's worth now and what it will be worth in the future. Make decisions based on forward-looking analysis, not backward-looking anchors. Fourth, use multiple reference points instead of a single anchor by looking at 10 comparable sales if you're buying a house, averaging them and adjusting for differences. Multiple data points reduce the power of any single anchor. Fifth, recognize when you're feeling anchored and consciously fight it. Because if you're refusing to sell something because it's below what you paid, that's anchoring. And if you're excited about a salary offer because it's more than your last job, that might be anchoring, causing you to accept less than your worth. And awareness is the first step to overcoming the bias. The fourth psychological trap is herd mentality and FOMO, the fear of missing out, which causes you to make financial decisions based on what everyone else is doing instead of rational analysis. Humans are social creatures, and we evolved to follow the group because being excluded from the tribe meant death. This instinct served us well for survival, but destroys us financially. When everyone is buying Bitcoin and getting rich, your brain screams buy, or you'll be left behind. Even though you're buying at the peak and setting yourself up for massive losses, when everyone is panic selling during a market crash, your brain screams sell before you lose everything, even though selling at the bottom locks in losses and misses the recovery. This is how every bubble and crash happens. In the late 1990s, everyone was buying tech stocks because everyone else was getting rich, and they didn't want to miss out. Rational analysis showed valuations were insane, but herd mentality overrode rationality. People who'd never invested before were quitting their jobs to day trade. Then the bubble burst, and people lost fortunes. Same thing with housing in 2008, where everyone was buying houses with no money. Down because prices only go up, and everyone is doing it, then the crash happened. Same with Bitcoin in 2017 when it hit $20,000 and everyone was buying. Then it crashed to $3,000 and all the FOMO buyers lost 85% of their money. Here's how herd mentality destroys your wealth. You see friends making money in some investment like cryptocurrency, stocks, or real estate. You feel intense FOMO and anxiety that you're being left behind while everyone else is getting rich. So you jump in without doing proper research or understanding what you're investing in. You buy at inflated prices because that's when the herd is most excited. Then when it crashes, you panic because everyone else is panicking and you sell at the bottom, locking in losses. You basically bought high and sold low, the exact opposite of wealth building, all because you followed the herd instead of thinking independently. The data on this is brutal, as studies show that the average investor dramatically underperforms the market, because they buy when everyone is excited and prices are high, and sell when everyone is scared and prices are low. The S&P 500 returned about 10% annually over the past 30 years. But but the average investor only returned about 3% to 4% because of behavioral mistakes driven by herd mentality. They're literally giving up 6% to 7% annual returns, which compounds to millions of dollars over a career because they can't resist following the crowd. Here's how to overcome herd mentality. First, recognize that when everyone is excited about an investment and saying you have to get in now, that's usually the worst time to buy. Maximum excitement equals maximum prices, and the best time to invest is when everyone is scared and pessimistic. But that requires going against the herd. Second, create a written investment plan and stick to it, no matter what the crowd is doing. Like, I will invest X amount in index funds every month, regardless of market conditions, and I will hold for at least 10 years. Having a plan prevents you from making emotional herd-following decisions. Third, limit your exposure to financial media and social media showing other people's wins, because every time you see someone posting about their crypto gains or stock wins, it triggers FOMO and bad decisions. Protect your psychology by limiting inputs. Fourth, study history and see how herd mentality has destroyed wealth in every bubble by reading about the dot-com crash, the housing crash, and every speculative mania. Seeing the pattern repeat makes you more resistant when you're in the middle of the next one. Fifth, be comfortable being different and going against the crowd, because the wealthy are contrarian by nature. They buy when others are fearful and sell when others are greedy. Develop that mindset and you'll make much better decisions than the herd. The fifth psychological bias destroying your wealth is overconfidence, where you overestimate your knowledge, abilities, and chances of success while underestimating risks and the role of luck. This causes you to take excessive risks, make poorly researched decisions, and lose money you can't afford to lose. Most people are overconfident about their financial knowledge and investment abilities. It's thinking they can beat the market by picking stocks, time the market by predicting crashes and recoveries, or find get-rich-quick opportunities that others are missing. The data shows this is almost always wrong. Studies prove that over 90% of actively managed funds underperform the market over 10-year periods. Professional investors with teams of analysts and sophisticated tools can't beat the market, but you think you can by reading a few articles and following some social media accounts, which is overconfidence. Day traders are even worse, as studies show that 97% of day traders lose money over time. But everyone who starts day trading thinks they'll be in the 3% who succeed. That's textbook overconfidence, where you're dramatically overestimating your abilities and underestimating how hard it actually is. Overconfidence also makes you underestimate risks by thinking, I can handle this debt, I'll pay it off quickly, but then unexpected expenses come up and you can't. You think, I can quit my job and start this business? It'll definitely work. But you haven't done proper market research and the business fails. You think, I know what I'm doing with this investment, but you don't, and you lose money. Overconfidence makes you blind to the things you don't know and the ways you could fail. There's a saying in poker and investing, if you can't spot the sucker at the table, you're the sucker. If you think beating the market is easy and you have an edge, you're probably the sucker getting taken advantage of by people who actually know what they're doing. Here's a specific example. You start investing and your first few stock picks do well, making you $2,000 in 3 months. Your overconfident brain says, I'm good at this. I have a talent for picking stocks. So you invest more money, maybe even borrow money to invest. But your early wins were largely luck, not skill. Then your next picks lose money, and you give back all your gains and more. Overconfidence made you increase risk right when you should have been cautious. And this pattern happens constantly. We're beginners. Luck creates overconfidence, which leads to bigger bets, which leads to bigger losses. Here's how to overcome overconfidence. First, assume you know less than you think you do. Approach every financial decision with humility and the mindset that you might be wrong, which makes you do more research, seek other opinions, and move cautiously. Second, study how much experts and professionals underperform, because if people with decades of experience and massive resources can't beat the market, why would you? And this should humble you into accepting that index fund investing is smarter than trying to pick stocks. Third, track your predictions and decisions by writing down your investment theses. Predictions and reasoning, then review them months or years later. You'll see how often you were wrong, which naturally reduces overconfidence. Fourth, Accept the role of luck in success by not just attributing it to your skill when investments go well, but recognizing that luck played a role, which prevents overconfidence from building. When investments go badly, analyze what you could have known or done better instead of just blaming bad luck, as this helps you learn. Fifth, seek out people who will challenge your ideas and tell you when you're wrong, because overconfident people surround themselves with yes men who reinforce their delusions. Confident but humble people seek out critics who keep them grounded. So find friends or mentors who will call out your overconfidence and protect you from yourself. The sixth psychological trap is the sunk cost fallacy, where you continue investing time, money, or effort into something because you've already invested so much, even though rationally you should cut your losses and move on. This keeps you trapped in bad investments, bad jobs, bad relationships, bad business ideas, all because your brain can't accept that past investments are gone and irrelevant to future decisions. Here's how this destroys wealth. You bought a stock at $100 and it's now at $40, so you've lost $60 per share. Rationally, you should ask, is this stock a good investment going forward from $40? But sunk cost fallacy makes you think, I've already lost $60. I can't sell now because that would lock in the loss. I'll hold until it gets back to $100. So you keep holding, even though the stock might drop to $20 or take a decade to recover. And you're letting a past sunk cost dictate a future decision that should be based only on forward-looking analysis. Same thing with education, where you spend 2 years and $40,000 on a degree, then realize you hate the field and the career prospects are poor. Rationally, you should cut your losses and switch paths. But sunk cost fallacy says, I've already invested 2 years and $40,000. I can't waste that by quitting. So you finish the degree and enter a career you hate, wasting decades of your life because the 2 years and $40,000 are gone. They're sunk costs. And the only relevant question is what path forward will make you happiest and most successful. But your brain can't let go of sunk costs. This happens with businesses too, where you start a business and invest $50,000 in 2 years of your life. It's not profitable, and the prospects are poor, so you should rationally shut it down and move on to something better. But sunk cost fallacy says, I've invested too much to quit now, so you keep pouring money and time into a failing business for years, losing even more. Entrepreneurs especially fall victim to this because they're so emotionally invested and can't objectively evaluate whether to continue or pivot, because they're trapped by sunk costs. The irony is that cutting losses early and moving on is often the path to success, but sunk cost fallacy prevents that. Here's how to overcome sunk cost fallacy. First, recognize that money and time already spent are gone forever, and they're irrelevant to the decision you face now. The only thing that matters is what choice will produce the best outcome going forward, and past investments should not factor into future decisions. Second, use the replacement test by asking if you didn't already own this stock or business or degree. Would you buy or start it today at current prices and circumstances? If the answer is no, then you shouldn't continue holding it, so sell or quit and move on. Third, set predetermined rules that force you to cut losses, like I will sell any investment that drops 20% from my purchase price. This removes emotion and sunk cost thinking from the decision, and the rule executes automatically. Fourth, get advice from people who aren't emotionally invested in your sunk costs, because they can see objectively whether you should continue or quit, while you can't because you're blinded by what you've already invested. Fifth, practice cutting small losses to build the mental muscle by walking out if you're at a bad movie 20 minutes in, even though you paid for the ticket. Ticket cost is sunk. And the only choice is, do I want to waste 2 more hours on a bad movie? Getting comfortable cutting small losses makes it easier to cut big ones when necessary. And finally, the seventh and most pervasive bias is recency bias, where you give too much weight to recent events and assume they'll continue into the future while ignoring long-term patterns in history. This causes you to make terrible predictions and decisions based on whatever happened most recently, instead of looking at the full picture. Here's how this destroys wealth. The stock market has gone up for the last 3 years. So you think it will keep going up forever, and you invest aggressively right before a crash? Or the market crashed last year, so you think it's too dangerous and you stay in cash, missing the recovery. You're letting recent events dictate your behavior instead of understanding long-term patterns. Cryptocurrency is another perfect example where Bitcoin went from $10,000 to $60,000. So everyone with recency bias thinks it will keep going up, and they buy at $60,000. Then crashes to $20,000, and they lose 2/3 of their money. Or it crashes, and everyone with recency bias thinks it's going to zero, so they sell at the bottom right before it recovers. Recency bias makes you buy high after things have already gone up a lot, and sell low after things have already gone down a lot, which is the exact opposite of good investing. Real estate shows this too, where prices went up for 5 years. So everyone thinks they can't lose, and they buy at the peak with maximum leverage. Then prices drop, and they're underwater and foreclosed, as recency bias causes every bubble and crash because people extrapolate recent trends infinitely into the future. The problem is that financial markets are cyclical and mean reverting, where what goes up comes down, and what goes down goes up. But recency bias makes us think recent trends will continue forever. When markets have been going up, we forget that crashes happen regularly. And when markets have been going down, we forget that recoveries always follow. So we're trapped in whatever is happening right now and can't see the bigger picture. Here's the data. In any 10-year period, the stock market has always been positive. But if you've measured it in any 1-year period, it's negative about 25% of the time. Recency bias makes you focus on the 1-year volatility and panic, or get overexcited, instead of trusting the 10-year pattern. Here's how to overcome recency bias. First, study long-term historical patterns and trends, not just recent data. Look at 30-year charts, 50-year averages, full economic cycles, as this gives you perspective that recent events are just noise in the bigger picture. Second, remember that markets are cyclical, where bull markets are followed by bear markets, which are followed by bull markets. And booms are followed by recessions, which are followed by expansions. Nothing goes in one direction forever. So when things are going well, remember that corrections will come. And when things are going poorly, remember that recoveries always follow. Third, create investment rules based on long-term data, not recent performance. Like, I will invest steadily through all market conditions. Because over 30 years, the market always goes up. Don't let recent volatility make you abandon a sound long-term strategy. Fourth, avoid making major financial decisions during emotional extremes, because when markets are at all-time highs and everyone is euphoric. Don't make big aggressive bets. When markets have crashed and everyone is terrified, don't sell everything and go to cash. Best decisions are made when emotions are neutral, not when recency bias is at extremes. Fifth, dollar cost average to remove the impact of recency bias by investing the same amount every month, regardless of recent market performance. This ensures you're not overreacting to recent events and trying to time the market based on what just happened. So let's put all 7 biases together and see how they interact to destroy wealth. Present bias makes you spend money now instead of investing for the future. Loss aversion makes you too afraid to take the necessary risks to build wealth. Anchoring traps you in bad decisions based on irrelevant past prices. Herd mentality makes you follow the crowd into bubbles and crashes. Overconfidence makes you take excessive risks and underestimate what you don't know. Sunk cost fallacy keeps you trapped in bad investments trying to recover losses. Recency bias makes you extrapolate recent trends and time the market badly. Every single one of these biases is costing you money constantly, and the worst part is they all work together and reinforce each other. Here's a typical example of how these biases destroy someone's wealth. You see Bitcoin going up and everyone talking about it? It's triggering herd mentality and FOMO. You buy at the peak because of recency bias, thinking the recent rise will continue. You invest more than you should because of overconfidence, thinking you understand it and can't lose. When it crashes, loss aversion makes you hold on, hoping it will recover. You're anchored to your purchase price and can't accept the loss. Sunk cost fallacy keeps you from selling even though you should, and you keep holding out of present bias, not wanting to face the pain of loss now. Finally, you sell at the bottom after years of losses, right before it recovers. Every single bias contributed to a catastrophic outcome. The good news is, once you understand these biases, you can design systems to overcome them. Automate investments to beat present bias. Use predetermined rules to overcome loss, aversion, and sunk costs. Ignore media and crowds to avoid herd mentality. Stay humble and use index funds to counter overconfidence. Study long-term data to overcome recency bias and anchoring. The biases never go away. They're hardwired, but you can build guardrails that keep you on track despite them. And that's the difference between emotional investors who underperform and disciplined investors who build wealth. So there you have it, the 7 psychological biases that are sabotaging your wealth and exactly how to overcome each one. Present bias makes you choose now over later. Loss aversion makes you too afraid of risks. Anchoring traps you with irrelevant numbers. Herd mentality makes you follow the crowd. Overconfidence blinds you to risks. Sunk cost fallacy keeps you in bad investments. Recency bias makes you extrapolate recent events. Okay, understanding these biases is more important than understanding any investment strategy, because even the best strategy will fail if your psychology is broken. Now here's what I need you to do. Pick the one bias that affects you most and commit to working on it this month. Maybe you'll automate investments to overcome present bias. Maybe you'll create loss-limiting rules to overcome loss aversion. Or maybe you'll stop following crypto Twitter to avoid herd mentality. Just pick one and improve.